How to find directional bias. Hello, this is Oliver from Braveheart Trading, and I help traders simplify their trading for consistency. Let's get straight into it. So in this video, we'll cover the following. Plus, receive a directional bias printout at the end. So start from the weekly open and find a directional bias for the week every Sunday. And directional bias consists of two components: weekly chart institutional order flow and weekly chart drawn liquidity. Let's discuss how to analyze both components for directional bias, starting with weekly chart institutional order flow. So what is institutional order flow? Institutional order flow is basically how price travels from point A to point B, and the algorithm that facilitates that movement is called IPSA. So here's an example of a price move from A to B. We have Feb sell side liquidity to November's inefficiency, and in between you'll have IPSA facilitate the transactions. Okay, it's all algorithmic nowadays, similar to ChatGPT and its wisdom. It's just better than humans nowadays. Okay, so how do we probe institutional order flow? Well, we'll start with a bullish example. Bullish institutional order flow consists of buy side inefficiencies holding price and down candles supporting price. Okay, this is what's going to hold lows. And for liquidity, price is going to trade through buy side liquidity and go to and through it. But if it hits sell side liquidity, it's going to quickly reject that and also trade to and through buy side liquidity. So all of this in synthesis, working together, is what we call bullish institutional order flow. So you got your PD arrays and you got your liquidity pools, and let's keep it as simple as that. So step one, look back 9 months of price data on the chart. Okay, so from the current weekly open, just look back 9 months, and that's a range for price data. Now, step two is probe for bullish institutional order flow using that data range. Okay, so just look at that diagram. What are inefficiencies doing? What are down candles doing? What are buy side liquidity doing? And what is sell side liquidity doing? So we can see here, sell side liquidity, for instance, we would breach it and then we quickly reject. And then we go to and through buy side liquidity here. Okay, we have sell side liquidity here taken out, 1, 2, into an imbalance. Then we switch, then we seek buy side liquidity again, this high and this high. Then we can see the down candles are now supporting prices. So this is just probing for bullish institutional order flow. And step three, respect the weekly chart's institutional order flow. So rule one is trust bullish institutional order flow on the weekly chart. Rule two is do not counter the bullish institutional order flow on the weekly chart. And step three is do not forget rule 1 and 2, because we are all human and we make mistakes. So try not to forget that. So I know we did the bullish examples, but bearish examples will be included in the PDF section. So now you have identified weekly chart institutional order flow. And now let's frame a draw on liquidity to complete the directional bias. So we have institutional order flow and draw on liquidity. We already have the institutional order flow. We already know the rules surrounding it. Now we need to complete that with a draw on liquidity. So let's get into draw on liquidity. What is draw on liquidity? So if institutional order flow is how IPSA delivers price from A to B, the draw on liquidity is Y. Why is it drawing from A to B? And specifically, it's doing so for specific points in the markets that have high interests. So if IPSA is just a facilitator, it's trying to find a counterparty A where there's a bunch of orders resting, and it's trying to facilitate that to the next area where there's a lot of orders resting. So that is the draw on liquidity. Why should price go from counterparty A to counterparty B? And inside of a move, there's going to be a winner and there's going to be a loser. There's going to be a winner here and there's going to be a loser here as well. So drawn liquidity will be either a liquidity pool, which is areas of pending buy stops and sell stops, or inefficiencies, areas that need to be rebalanced. So let's do examples of liquidity pools. Simple, just previous week's highs like this, or buy side liquidity like this as well, which is intra-week high. We've got short-term lows here. These are just liquidity pools. You can see how these areas, they have a lot of interest around them, and after that they seek another area of interest. So we say these areas are draws on liquidity. But we also have inefficiencies that are draws on liquidity as well. So we have the liquidity under here, hit this fair value gap, start seeking this inefficiency before the liquidity pool, and that's just inefficiency. It's just the internal range liquidity. This is the external range liquidity. So now find the draw on liquidity following the weekly chart's institutional order flow. So just make sure you follow the steps of a data range, identifying what the institutional order flow is, and then following the rules. And then start to classify the two types of draw on liquidity, which is a short-term draw on liquidity, which is a low-hanging fruit target. It's just easy for the week to seek. And then there's a long-term draw on liquidity, which is like a weekly range expansion target. So where does IBTA actually want to take this for the week? And you can get rewarded if you are able to anticipate that. So we have a short-term draw on liquidity and a long-term draw on liquidity. This is short-term, so it's for the week here. Short-term, and then once we pass the short-term, it's now the long-term draw on liquidity. And terminus is when the draw on liquidities have been met. So mostly the long-term draw on liquidity. And this is when you end and stop following the directional bias. So now that we understand that, let's start getting practical and identifying the two types of draw on liquidities to complete your directional bias. So you know weekly institutional order flow, you know draw on liquidity now. Let's find the draw on liquidities now. Let's see how we can find that so we can complete the directional bias once and for all, and then move on to the next step. So this is short-term draw on liquidity. A short-term draw on liquidity is the nearest objective for the week. So there's two types of short-term draws on liquidities. There's type 1, which is the nearest previous week's high, and you're going to use a 3-week look back from Sunday's open for that. Or there's type 2, which is the furthest previous day's high, and you're going to use a 3-day look back for that. Okay? It's just as simple as that. So if type 2 draw on liquidity is expired, so that should be, type 2, previous day's high. We can see here, Sunday, we look back 1, 2, 3. Yeah, so basically 3 ranges. We can see this, it's pretty much expired already. So what do we do then? We seek the type 1 liquidity here, which is the nearest previous week's high, but we have to use a 3-week look back for that. So instead of a 3-day look back here, because it's expired, we now seek the type 1. So you can see there's different filters for this. And now we're using a 3-week look back, and we can see we're using the nearest previous week's high. This previous week's high has already been breached, so we're using the second one here, and that is the short-term draw on liquidity. Now, the short-term draw on liquidity is the low-hanging fruit objective for IBTA. Okay, so if IBTA wants to facilitate a move from A to B, it needs objectives like this. Now let's talk about the long-term draw on liquidity. Long-term draw is beyond the short-term draw for the week only. So there are two types of long-term draws. There's a valid liquidity pool beyond the short-term draw on liquidity, or a valid inefficiency beyond the short-term draw on liquidity. So the long-term draw is valid only if the liquidity or inefficiency matches time theory. This is what makes the long-term draw valid. So the time theory is previous month's ranges, previous week's ranges, or previous day's ranges. It's just as simple as that. Now, if the long-term inefficiency or the long-term liquidity pool is matched with monthly high, weekly high, or daily high, then we can say that is a long-term draw valid, but we have to make sure that's beyond that look back we did for the short-term draw. So here's an example of long-term draw. We have previous month's liquidity. So this is the short-term draw. This is expired. So beyond the short-term draw, we have this liquidity pool here, which is also previous week's high. But once we look at it in detail, it's actually the previous month's high. So it's a valid long-term draw. Even if it was a previous week's high, since it's beyond the short-term draw, it would have still been a valid long-term draw. Okay? Just need to be beyond the short-term draw. And this one is, I wanted to show the inefficiency, but I got a bit of typo mistake here. So anyways, beyond the short-term draw here, there is this long-term draw on liquidity, and this inefficiency, and this high of May. So these are all long-term draws, and this is what happened for this week. It just, after it cleared this, since gold's in price discovery mode right now, there's a lot of volatility. It just sought after June's high, May's inefficiencies, and May's highs. So now you have directional bias for the week, okay? Weekly, which is weekly institutional order flow, for instance, a buy program, or it's weekly draw on liquidity, okay, which is a short-term draw and a long-term draw. So remember that directional bias for the week will end at terminus. So here's some rules for terminus. Short-term draw on liquidity. If the markets are lacking volatility, which means in a consolidation, then consider terminus at the short-term draw on liquidity because the markets are not volatile. But if the markets are experiencing volatility, such as gold, then strive for the terminus at the long-term draw on liquidity. Simple as that. So let's get into some examples. For this, follow this simple mental model for directional bias every Sunday. I want you to print this out. I will include it in below, and then just print it on your wall, and you see it every day so that your subconscious mind is seeing that every day. And this is what it's like. It's just the 2 steps. Weekly institutional order flow, draw on liquidity, some mental models to help that. So like A to B, you got institutional order flow in the middle, and you got the draw on liquidity from A to B. But how is it going to go from A to B? It's going to do so with all of these components of institutional order flow, which are based on draw on liquidity, inefficiency in liquidity pools, but also monthly, weekly, and daily ranges. So example 1, this is directional bias, A to B, and the draw on liquidities have been outlined already in this examples. And here is an example of the exception model, which is going to be following that bias. So we're only going to pick one side of the market, and the exception model will be explained later on, where there's a trigger, there's a confirmation, and then there's a participation on everything that you've outlined. So even if you outlined a directional bias, but you don't get any confirmation, you don't take the trade because that would be a dumb move. So here's an example 2. I include a bearish scenario here. We have the move from A to B. We have the short-term draw and the long-term draw. Low-hanging fruit, objective. And we have 8:30 opening, 9:30 opening with a displacement lower. Price then trades into a 5-minute fair value gap. Then we have the trigger, confirmation, participation, and we're only going to be looking for a 2R trade. Okay, so notice these trades right here, they're only 2R. That's all I want for you is 2R to 1.5R, and then gradually we can work on increasing that later on once we have more understanding of narrative and frameworks. So summary, how to find directional bias. 1. Identify, follow, and respect the weekly chart's institutional order flow. 2. Identify short-term and long-term draw on liquidity in the direction of the weekly chart's institutional order flow. So following step 1. Don't go to step 2 straight away. And then 3 is end and stop the directional bias from step 2 and 1 at terminus or at the end of a timeline. Okay, so we'll cover what timeline is, But timeline is, instead of using drawn liquidity as terminus, which is price theory, we're going to use time theory for terminus. So stay tuned for that in the next episode. But before we do that, make sure you understand this one so we don't complicate things. And that's about it. So thank you for watching. See ya and bye. And also, if you have a big enough why, you'll figure out how.